Time can make you wealthy, but most people interrupt it before it has the chance. Compounding is a quiet miracle, and impatience is what destroys it. Welcome back to Invest in Wisdom, a calm place to learn powerful ideas from great thinkers and timeless principles. If you enjoy learning in a quiet and thoughtful way, consider subscribing and let's grow wiser together. Today we explore Charlie Munger's first rule of compounding and why so many investors fail before success has a chance to begin. Compounding is one of the quietest and most powerful forces in investing. It begins slowly, almost without movement, and then grows in a way that feels effortless. But even though it is powerful, it is also extremely fragile. And Charlie Munger captured this perfectly with one idea: never interrupt it unnecessarily. This principle sounds simple, yet it goes against human nature. People want results quickly. They want progress they can see. So when growth feels slow, they feel the urge to intervene. That moment of intervention is exactly what breaks compounding before it can reveal its strength. Most investors do not fail because they choose the wrong companies. They fail because they do not allow time to do its job. They trade too often, react to short-term noise, and chase small movements in price. Every time they jump in and out, they reset the clock on their wealth. Compounding needs time, not intelligence, not prediction, not perfect timing, just time. It is the engine that multiplies small decisions into meaningful results. When you interrupt it, you interrupt everything. One of the most common ways investors break compounding is through overtrading. Every trade introduces friction, fees, taxes, emotional stress. These frictions may seem small in the moment, but they take a heavy toll over the years. The more you try to control every move in the market, the more you work against your own long-term results. Munger understood that wealth is often built by holding great businesses for long periods. Strong companies reinvest earnings, expand their advantages, and compound value internally. When you stay with them, their compounding becomes your compounding. But when you interrupt the process, the growth collapses back to the beginning. You don't just lose money, you lose time. And time is the one thing you can never recover. Many investors cut their winners early and hold their losers too long. They sell strong companies because the gain feels temporary, and they hold weak ones because the loss feels painful. But compounding does not reward emotion. It rewards patience. The truth is that great companies rarely need your interference. They grow without your involvement. Your job is not to manage their daily movements, but to stay out of their way. Compounding rewards inaction, not careless inaction, but intentional stillness. It comes from knowing you have chosen wisely and allowing time to magnify your decision. To apply this principle in real life, choose businesses you can hold for years. Reduce unnecessary trades. Ignore the noise that tries to pull your attention away. Review your investments only when the fundamentals change, not when the headlines do. Ask yourself simple questions. Am I acting because something truly changed, or because I feel impatient? Am I interrupting compounding for emotional comfort, or am I letting time do what time does best? Most regrets in investing come from interruption. Interruption of good decisions, interruption of long-term opportunities, interruption of the quiet work that compounding does behind the scenes. Charlie Munger often said that the big money is in the waiting. Waiting is not weakness, it is strength. It is the choice to let years reward you in ways that days cannot. Compounding is like planting a tree. You do not dig it up constantly to check the roots. You give it time. And one day, you look back and realize that something small has grown large enough to change your life. The first rule of compounding is simple. Do not interrupt it. Protect the process. Let time work. And in the long run, you will discover that the greatest advantage any investor can have is not brilliance or luck, but the discipline to stay out of their own way. Overtrading is one of the most silent destroyers of long-term wealth. It does not feel dangerous in the moment. In fact, it often feels productive. Every trade feels like action. Every action feels like progress. But the truth is that frequent trading slowly eats away the very foundation that compounding needs to survive. The cost of overtrading is rarely obvious. It does not appear as a single dramatic loss. Instead, it shows up as a slow bleed, a quiet erosion that takes place trade after trade, month after month, year after year. And by the time most people notice it, the damage is already done. The first hidden cost is friction. Every transaction you make carries fees, spreads, taxes, and small disadvantages that accumulate over time. Each one feels tiny, almost harmless. But compounding works in both directions. Just as small gains multiply over decades, small frictions also multiply. Only against you. Think about it this way. A great business compounds internally. Its earnings reinvest, its competitive advantage deepens, and its value quietly grows. When you hold it, the business is doing the work for you. But every time you sell, you are interrupting that process. You force yourself to start the compounding journey all over again with a new decision, a new entry point, and a new set of unknowns. Overtrading isn't just costly financially, it is emotionally draining. Humans are not built to make dozens of high-stakes decisions in environments full of noise. Every trade requires mental energy. It pulls you into the short term. It makes you sensitive to every fluctuation. Your mind becomes wired to react rather than reflect. And when your emotions become reactive, your decisions become impulsive. You start seeing patterns that don't exist, threats that are not real, and opportunities that are nothing more than noise. In this state, the market becomes a storm instead of a landscape. You lose the stability required for long-term thinking. And without long-term thinking, compounding cannot survive. Charlie Munger understood this deeply. He once said that a major part of being a great investor is having the temperament to do nothing when everyone else is doing something. Most of the time, activity is the enemy. Stillness is the advantage. Consider how the market behaves. Prices move every second, not because businesses change every second, but because human emotions change every second. When you overtrade, you tie your results to those emotions. You become synchronized with market noise instead of business value. The second hidden cost of overtrading is opportunity loss. Every good investment needs time to mature. But when you jump from idea to idea, you never stay long enough to benefit from the years where true growth happens. A tree does not grow faster because you keep moving it. In fact, Moving it keeps it from growing at all. Every time you sell a long-term compounding machine to chase a short-term move, you are giving up the most valuable phase of growth, the phase that only appears after years of patience. The market rewards endurance, not motion. It rewards clarity, not noise. It rewards the investor who can sit with uncertainty without being seduced by the illusion of constant action. The final hidden cost of overtrading is psychological addiction. The more you trade, the more your brain craves the stimulation, the rush of buying the relief, of selling the thrill of short-term outcomes. These emotions create a cycle that feels rewarding but destroys discipline. Soon, you are no longer investing. You are seeking dopamine. And dopamine is the enemy of compounding. Compounding requires boredom. It requires long stretches where nothing happens and you do nothing in return. Most people cannot handle this. They mistake boredom for danger. But in investing, boredom is often a sign that you are on the right path. So how do we escape the trap of overtrading? The answer begins with recognizing that great investments do not need your constant attention. They need space. They need silence. They need time. Choose businesses with durable advantages that can grow for years. Design your strategy so it rewards patience, not movement. Review your holdings based on fundamentals, not fluctuations. Remind yourself that the market's noise is not a signal, it is a test. And every time you feel the urge to act, ask yourself a simple question. Is this decision strengthening my compounding or interrupting it? Most of the time, the honest answer is clear. The hidden cost of overtrading is not just money. It is the life you could have lived if you had allowed your best decisions the time they needed to bloom. Overtrading is interruption. Patience is protection. And the investor who learns to resist unnecessary action is the one who finally unlocks the full power of compounding. There is a simple rule in investing that many people hear, but few truly follow. Don't cut the flowers and don't water the weeds. Charlie Munger loved this idea because it captures one of the most common mistakes investors make. They sell their best companies too early, and they hold on to their worst ones for far too long. Why does this happen? Because gains make people nervous, and losses make people stubborn. When an investment rises, many fear the profit will disappear, so they lock it in quickly. When an investment falls, they refuse to let go, hoping it will return to the price they paid. Emotion flips logic upside down. But real compounding does not come from selling winners early. It comes from allowing great businesses to grow far beyond what you can imagine in the beginning. The big returns do not appear in the first month or even the first year. They show up after long stretches of patience, when a company's internal compounding finally accelerates. The problem is that most people never stay long enough to experience this. They cut the flowers just as they start to bloom. They interrupt the compounding process right when it becomes powerful, and at the same time, they water the weeds. They pour time, hope, and money into companies that are shrinking just because selling them would mean admitting a mistake. A declining business cannot be saved by your patience. A rising business does not reward your fear. Each one grows or dies based on its economics, not your emotions. The wise investor learns to separate feelings from fundamentals. A great business stays great because of its competitive advantage, strong management, healthy financials, and the ability to reinvest profits at high returns. A weak business stays weak because its economics do not improve with time. Your job is not to rescue the weak, but to hold on to the strong. When you sell a strong company too early, you may lock in a small gain, but you sacrifice the possibility of a life-changing one. History is filled with investors who sold too soon and spent the rest of their lives wishing they had simply waited. On the other hand, watering the weeds drains your energy and traps your capital. Money stuck in dying businesses cannot compound. Time spent hoping for a rebound is time lost forever. The market rewards those who hold on to their flowers. The rare companies that keep growing, keep reinvesting, keep improving, and it punishes those who insist on saving the weeds. So the real discipline is this: when you find something great, let it grow. When something keeps shrinking, let it go. Do not interrupt the strong, and do not carry the weak. Compounding is a garden. Your future depends on what you choose to nurture and what you choose to remove. Time is the most powerful partner an investor can have. It works slowly, quietly, and without asking for your attention. Yet it is the force that turns small decisions into extraordinary results. Charlie Munger understood this better than almost anyone. He knew that wealth does not grow because we are constantly active. It grows because time multiplies what we choose to hold. Most people underestimate how much time contributes to compounding. They focus on choosing the right stock, the right moment, the right strategy. But once a strong business is chosen, the next step is not constant action, it is endurance. The long stretches of doing nothing are not a lack of progress. They are the foundation of progress. Compounding is not just a financial mechanism, it is a relationship with time. Every year you hold a great company, time adds another layer of growth, expanding its revenue, deepening its moat, strengthening its management, and reinvesting profits into the next cycle of expansion. But to benefit from this, you must allow time to work without interference. The more you intervene, the more you reset the compounding engine. This is why Munger often said that the big money is not in the buying and the selling, but in the waiting. Waiting does not come naturally to most people. We live in a world that rewards speed, novelty, and constant motion. But markets do not operate on the rhythm of our impatience. They move in cycles that unfold over years, not days. And the investor who aligns with these cycles, rather than fighting them, gains the greatest advantage. Volatility often tricks people into believing they must act. A sudden drop creates fear. A sudden rise creates excitement. But neither emotion reflects the true value of a business. The internal growth of a strong company continues regardless of short-term price movement. What matters is not what the stock does this week, but what the business becomes over the next decade. Time does the heavy lifting by magnifying good decisions and exposing bad ones. A weak company cannot hide behind time. Its flaws become clearer each year. A strong company becomes stronger with every cycle. The longer you hold it, the more obvious the difference becomes. This is why patience is not passive. It is a strategic choice. It is the decision to let the future reward you in ways the present cannot yet show. to hold on when others panic, to stay calm when others react, to trust that long-term value is built beneath the surface long before it appears in the stock price. Time will not turn a bad investment into a good one, but it will turn a good investment into a great one, if you let it. To let time carry the weight, you must stop trying to force outcomes. Choose well, hold long, let compounding breathe, let time do what only time can do. To apply all these principles in real life, investors need a framework, something simple, durable, and grounded in discipline rather than emotion. Charlie Munger believed that good investing is not complicated. It is about doing a few things well and avoiding the many temptations that break compounding long before it has a chance to flourish. The first element of the framework is clarity. You must know what kind of businesses you want to own. Great companies are not mysterious. They have durable advantages, strong leadership, healthy financials, and the ability to reinvest profits at attractive returns. When you choose businesses with these traits, time becomes your ally instead of your threat. The second element is reduction. Reduce unnecessary trades, reduce emotional reactions, reduce the noise you expose yourself to. The world constantly pushes investors toward activity, but activity is rarely the source of long-term wealth. Stillness allows compounding to breathe. Restraint allows wisdom to guide you instead of fear or greed. The third element is review with purpose. You do not ignore your investments, but you evaluate them based on fundamentals, not fluctuations. Ask simple questions. Is the company still growing? Is its competitive advantage intact? Are the managers still allocating capital wisely? If the answer is yes, your best action is usually inaction. The final element is alignment. Your strategy must align with your temperament. It must be something you can stick with during volatility, uncertainty, and boredom. The best investment plan is useless if you cannot follow it. Munger often said that success in investing is more about character than intelligence. A calm mind, a long horizon, and a willingness to stay the course. These qualities matter far more than predicting the next move in the market. When you put all these pieces together, you create a simple but powerful framework. Choose well, trade less, think long, let compounding work. Protect the process instead of interrupting it. Wealth built slowly is wealth that stays. And the investors who embrace this mindset will not just grow richer financially, but wiser in the way they approach every part of life. Compounding is not a secret, yet few allow it to fully unfold. Most investors interrupt it through impatience, fear, or the illusion of control. But Charlie Munger showed us a different path, a quieter, wiser way to build wealth, a way that honors time instead of fighting it. Do less, but do it better. Choose strong businesses. Hold them long enough for their strength to reveal itself. Avoid the noise that pushes you into unnecessary action. Protect the process rather than interrupt it. In a world addicted to speed, compounding rewards those who can move slowly, those who can sit with silence, those who trust time more than impulse. If this way of thinking speaks to you, and if you want to grow wiser with every episode, consider subscribing to the channel. Let's keep learning, keep compounding, and keep building a future shaped by patience and clarity.